The S&P 500 starts the week fresh after hitting a new record high on Friday. China's GDP beats expectations, but a big fourth quarter jump is required to hit the official growth target. And Japan's core inflation continues to support cautious BOJ rate hikes. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ head of G3 Economics Brian Martin reviews September data in the US to explain why market pricing for November and December rate cuts are starting to be dialed back.
The market's taking on board now the strong data and saying the FOMC cannot proceed at a very rapid pace in cutting interest rates if it wants to ensure that it does hold on to the improvement we have seen in inflation.
But first in 5 and 5 with ANZ. US equity markets start the week after closing at a new record high on Friday. The S&P 500 rose 0.4% on the back of strong guidance from Netflix. Also out on Friday though, housing starts fell 0.4% in September, indicating some weakness in activity. But as ANZ head of G3 Economics Brian Martin explains, that followed a 7.8% rise in August. Looking through that volatility, Brian says the picture still looks relatively healthy.
When you look at the 6-month moving average, that's running quite healthily at about plus 1.6%. And that does suggest, therefore, that the underlying temperature in the residential construction industry remains positive and one that does support ongoing modest contributions to growth from that sector at the moment, despite the fact that mortgage rates are still high.
And the Aussie dollar will start the week at 67.06 US cents, while the Kiwi is at 60.70 US cents. Number 2, looking to the week ahead, today we have lending rate decisions in China. Then Brian says October PMIs for major economies on Thursday will give a sense of momentum at the start of Q4, particularly in Europe, where PMIs are watched more closely.
The expectation in the market is that the PMI for the euro area stabilised in October at 49.7, so only up 0.1, but remained below 50. And if that is the case, that's going to reinforce expectations that the euro area region is continuing to lose economic momentum. I think if the numbers are confirmed as such, that's just going to fan the debate about whether or not the ECB will need to cut interest rates again in December, and indeed whether or not it should consider increasing the magnitude of rate cuts from 25 to 50 basis points.
Number 3, Japan's headline inflation fell to 2.5% year-on-year in September from 3% in August. That was the first decline in 5 months. ANZ FX analyst Felix Ryan says the fall doesn't necessarily reflect a new direction of travel. A core measure rose from 2% to 2.1%, just above the BOJ's target. And important components of services inflation are still rising.
Looking through some of the noise a bit and just excluding some of the volatile items and services like airfares, package holidays, dining out costs, the CPI services does still seem to be rising. And that is reflective of the stronger wage costs and also the rebound in consumer demand that we're seeing in the Japanese economy. So I think overall, just looking at those core measures there and underlying pressures, it is still something I think that BOJ will be pleased to see in terms of developments with services and underlying inflationary pressures. So that does still leave further policy normalisation on the near-term outlook. And, that does sort of reaffirm our view of a December rate hike at this point.
Number 4. China's CSI 300 stock index, which has been on a bit of a ride in recent weeks due to the disappointment around stimulus briefings, starts the week on the back of a 3.6% rise on Friday. That came as China's GDP rose 4.6% in Q3 from a year ago. That was slightly ahead of market consensus, but ANZ economist Vicky Xiaozhou says while that's a positive, growth has still slipped from 5.3% in Q1 and 4.7% in Q2.
To achieve 5% GDP growth target in 2024, China has to reach at least 5.2% growth in Q4, which was the Q4 GDP growth in 2023. We expect China's recent stimulus package will bring positive momentum in China's economy, and we maintain our view of our GDP forecast this year at 4.9%.
Number 5. Also out on Friday was data on China's industrial production. It rose 5.4% in September, led by high-tech and shipbuilding industries. That followed a 4.5% rise in August. Vicky says that's just one side of a two-speed economy, though, with China's property market continuing to drag.
The property data print are still very weak. We saw the new home price month-on-month dropped by 0.7% and the second home price dropped by 0.9%. In parallel, property investment dropped by 10.1%. We expect a quick injection to the whitelist projects will provide the property market some short-term boost.
Vicky Xiaozhou there. Now in our bonus deep dive interview, ANZ head of G3 Economics Brian Martin looks at how market pricing for US rate cuts in November and December has reduced following a strong month of September data.
We have now had the publication of the main economic indicators that we're going to get for the US this month. Universally, they are pointing to a re-acceleration in economic activity in the latter stages of the third quarter. Non-farm payroll growth in September was strong. It rose 254,000. The unemployment rate fell back to 4.1% at the end of the quarter from being 4.3% in July. So it does look as if the labour market is intact and is certainly not close to recession at the moment. The retail sales data we had for September, they were also strong. Control group sales in particular, which are helped to use calculate the GDP data, they rose 0.7% in September. And the 3-month moving average is up at 0.47% for the third quarter, up from 0.3% in the second quarter. So that again indicates that the risks are GDP growth accelerated during Q3.
And so looking at inflation measures, what are we seeing there?
And then there was the core inflation numbers for September. For the CPI, they firmed they were 0.3%. And some of the data on inflation very recently is indicating that potentially the disinflationary pulse that we saw in the economy just a few months ago may now be dissipating. Certainly supercore CPI inflation has been climbing higher the last few months. And that does suggest that a degree of monetary restraint is still required in order to ensure inflation comes back down to target. I think it's a combination of all that is just making the market a little bit less gung-ho about the speed with which the FOMC will approach the easing cycle.
So what is the market pricing at the moment for what the Fed might do in the final 2 months of the year?
Only a few weeks ago, before the September data was released, the market was putting a reasonable probability, about 40%, chance that the FOMC would cut rates by 50 basis points when it meets again in early November. However, that's been dialed back, and expectations now are 90% for a 25 basis point cut in November, and only a 70% probability that rates will be cut again in December. So I think the market's taking on board now the strong data and saying the FOMC cannot proceed at a very rapid pace in cutting interest rates if it wants to ensure that it does hold on to the improvement we have seen in inflation that has been hard fought over the last couple of years, and indeed the labour market balancing too. So my assessment is that all of this plays into a cautious rate cutting cycle from the FOMC, and I would have thought that Fed speakers over the coming week, of which there are 7 scheduled to speak, will reinforce that message.
Brian Martin there. I'm Alex Tarrant, standing in for Bernard Hickey. That was 5 and 5 with ANZ for Monday, October the 21st. Catch you tomorrow with an in-depth look at China's latest attempts to jolt its property market into life.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.